Good day, fellow investors. One of the best investing books out there, and it is the best because it was written by one of the best investors out there ever, is One Up on Wall Street by Peter Lynch. And the first 90 pages of the book are dedicated to stock market beginners and how to prepare for investing. So the best investor ever is giving us tips on how to start investing and how to invest, and this is summarized in this video. Peter Lynch was Fidelity Magellan's head investment manager for 13 years from 1977 to 1990, where he turned $1,000 into $28,000 over 13 years for a yearly investment return of 29.2%. $1,000 into $28,000, and he's telling us how to do that too. But perhaps even more importantly, his wife invested $750 a year into her IRA account from 1974 to 1978. Thus, in total, just $4,500 invested. He managed that money and he turned that money into more than 10 million. Now the account has 8 million, starting with just 4,500, and 3 million has been taken out for weddings and other things. So that's Peter Lynch, over 40 years, 20%, and you can turn a few thousands into tens of millions. If you want to learn how, if you want to have a similar path when it comes to investing over your investing life cycle, stick to this video. Also, click like, subscribe to this channel, and click that notification bell so that you get notified when there is a video out that's very important for you. Let's start with the content. So, I've tried to summarize all of this and answer the most important questions that a stock market beginner might have. What is a stock? What's a price earnings ratio? How does the stock market work? How to start investing? Am I the right person to even invest? Is the stock market a gambling place? Is it worth to invest small sums, just $1,000? And we have seen how it is worth, because you can turn 1,000 into tens of thousands and millions if you just follow the right steps. And we're going to discuss those right steps. Extremely important steps to understand, because 99% of people on the market are not following these steps. They are gambling. You have to be an investor, and that's what makes all the difference. When it comes to investing, you're investing in stocks. But what is a stock? Many say the stock market is for gamblers, but a stock is just a piece of paper, electronic paper today, that represent ownership in a business. So you are part owner of a business. So if you are a part owner of Walmart, Nike, Cargill, and other big businesses, are those owners gamblers or are they investors? Sam Walton, the founder of Walmart, was an investor. Nike, investment, Cargill, and all those big businesses, people don't go around telling Jeff Bezos or Bill Gates they are gamblers. No, those are investors. Those are mostly business owners. And that's the core concept also of Peter Lynch's. You have to be a business owner. Forget about the stock market. A stock market is just something that is a vehicle that gives you business ownership. And if you can get that, then your investment path to millions is pretty well set. Further, on the gambling topic, yes, stocks are volatile. The prices go up and down because 99% of people on the stock market are gamblers. You have to be an investor and take advantage of the gamblers and don't be taken advantage of. Because yes, stocks are volatile, and if you look at this chart, the white line that represents $1 invested in stocks in 1802, that turned into more than 1 million. Yes, $1 into 1 million. The chart, the line, the white line is very volatile. But this doesn't mean that stocks are risky over the long term. Stock prices go up and down, yes, but if you invest in businesses, businesses grow, businesses deliver earnings, dividends, so it's not really risky. You are just a business owner. It's risky to hold cash, to hold bonds, because if you hold cash, $1 from 1802 is now just 4 point something cents. So it lost 95% of the value due to inflation. That's for me risky. Owning businesses is not risky because it's one of the best investments out there, alongside owning real estate. To dig deeper into this subject, we are going to compare earnings and stock prices, and for that we're going to use a price-earnings ratio. Because if you invest in businesses, you're focused on the earnings, not on the stock price. Stock market investors today are focused on the stock price, and you can see that by watching Apple's stock price. It was below 100 just 3 years ago, then it went up to 220, then it crashed to 150, and now it's up to 280. And most investors, except for Buffett, look at those stock prices and think, okay, where will Apple's stock go up next? As an investor, you don't care where the stock will go next, you care where the earnings will go next. And one important metric that helps when it comes to investing is the price-earnings ratio. The price-earnings ratio is the ratio of the stock price versus the earnings. The earnings is what delivers your stock market returns. In this case, Apple's earnings have gone up from $10, 9.74 to the current $11.89 per share. However, the stock price went from 100 to 280, which means that the price-earnings ratio